In this video, we're going to take you from the point of knowing which pair you want to trade and the reasons why, to actually pressing the button and managing the trade that you're in. From a professional perspective, trade management is not about following some robotic rules, but rather making sure you operate freely inside a protective framework. This allows you to trade whatever opportunities you see for whatever reasons you like, while making sure your account is safe and you don't lose more money than you're comfortable risking. So let's imagine that we have done our fundamental analysis and we now know the exact pair that we want to trade and in which direction we want to be trading it. The next step is entering the trade. Entering a trade is entirely dependent on the situation and the type of opportunity you have. Over time, you'll definitely start to understand that some opportunities require you to jump in right away, while others are best left until the price pulls back a little bit from its current levels. As a general guide, the bigger the news and the more of a shock or surprise it is to the markets, the quicker you should get in and enter. So for example, if a bank unexpectedly cut its interest rate, that would be pretty extreme, but almost guaranteed pips. As long as the market was not expecting it, the price will move as the market overreacts. On the other hand, if the general sentiment of the market was negative for a currency, and then we had some slightly worse than expected data from that country, we could reasonably expect sellers to start watching that currency, but they're hardly going to start flocking to jump in when they already half expect bad data and negative things anyway. As you can see, it's your fundamental analysis that will tell you most about your entry. The key to a good entry is deciding what the market will do based on the same information so that you get to ride the move with it. You won't ever predict it 100% of the time, but you will definitely improve and reach a point of consistent income if you follow the steps of fundamental analysis and practice. Another rough guide is to also look at the age of the news. If something extreme and surprising happened last week, it's much less likely to generate a move today. Conversely, if it happened 10 seconds ago over the audio squawk, then this is something you will want to act on right away, as there will definitely be pips to be made. Entering these trades based on extremely surprising news that is breaking in the present time is simply a case of getting into the market as quickly as possible. Speed of entry is more important than any specific price level, because if you have a higher chance of the market moving in your favour at that moment. There will be a lot of other opportunities, however, that do depend on you entering at a good price level. Because the slightly older or less surprising information, the probability of the price moving right away is reduced, as the market starts to have different opinions on how important the information is. As a general principle, if you're not looking to enter at the current price, professional traders will look for pullbacks and breakouts to guide them with their entries. For breakouts, simple areas such as the high and low of the previous or current session are often used. This is very simple yet extremely effective when your fundamental analysis is good. For pullbacks, a common method is to look for recent levels of support and resistance, maybe even a good confluence of things where these support and resistance levels line up with things like pivot points, Fibonacci retracements. When a trader is learning inside a firm, their real skills are developed by sitting next to a professional trader who acts as their mentor. When the opportunity comes along, the junior sees how the professional handles it and then never forgets that experience. This is why we give you access to our trading coaches. To become a coach, they have to demonstrate a profitable track record to us and demonstrate that they have a deep understanding of the concepts we teach. By contacting your coach and discussing your trade opportunities, you will get the benefit of their experience and they will help you find good prices at which to enter. Most importantly, they will explain the reasons behind all of their advice so that you can learn and develop as a trader. Don't be afraid to spend a few weeks watching, asking and learning before aiming for an income. Progression is gradual and Mr. Market will continue to provide you with opportunities each and every day. So now you've entered a trade, the most important step is to make sure your losses are limited and your account is protected. And we do this in two ways. First of all, there is a stop loss. The stop loss is simply an automatic order that closes your trade if you lose a certain amount of money on a position. Stop losses are very important because if you decide where to put it right at the beginning of the trade, before the emotional attachment of it starts affecting your judgment, and they cut your loss with a cold indifference that you may struggle to display in the heat of the moment. The second manner of limiting losses is by carefully planning your use of leverage. For example, In normal circumstances, when you see general opportunities in the market, the use of leverage is not recommended. A trade without leverage is a simple calculation we covered earlier in this course, but essentially it's when you open each position at the same size as your overall account balance and lower. To keep it simple, one standard lot is 100,000 units of currency, so you would only trade positions of one standard lot when you have 100 grand in your account. If you only have 10k, then you would bring it down to one mini lot, and if you have 1k, you would bring it down to a micro lot, and so on. If you traded two standard lots with your 100k account, then you would be trading at 2-to-1 leverage, because you are trading a position that's twice the size of the balance of your account. This sounds complicated, but the idea of this course is to keep everything as simple as possible without making it unrealistic. You can research lot sizes and leverage in many free sources online, but the most important thing to know is if you trade with neutral leverage or 1-to-1, as in the examples we looked at, 100 pips of profit or loss will roughly equate to 1% of your account balance. Just like your style of entry, use of leverage should change based on how high the probability of the trade is. High impact, unexpected events that are extremely likely to send the price in one direction can be great events with which to significantly increase the balance of your account. These types of trades are rare, and waiting patiently for them to come along with carefully executing leverage will be one of the core ways that you achieve a consistent extra income. General trading opportunities that come along daily or weekly and are not based on anything overly shocking or surprising will be traded without leverage to mitigate the lower probability. The biggest reason retail traders fail to make money and even lose their money is because they try and apply leverage in the same manner on all trades, in a robotic manner that doesn't reflect the realities of a live market environment. On the other hand, the big traders that make fortunes all do so because they become experts at increasing their leverage at the correct times and being patient for the rest of the time. As a general guide, professional traders will day trade with a stop loss of between 30 and 50% the current average daily range for that pair. So if the pair has a range of 100 pips, you should be looking for a stop loss of around 30 to 50 pips. You can also use technical levels on your price chart to help you place stops. Generally, look for places that seem to have a good reaction or bounce from the price. The idea is that the market really is looking to trade in the direction you think, then it's a low probability that the price will move beyond that already proven level. The combination of market sentiment and the fact that traders already traded from that level gives you a good chance of the stop loss being safe. If you want to take advantage of longer term positions, then increase your stop loss based on the amount of time you think you'll be in the trade. For example, a week, use the stop that's 30 to 50% of the average weekly range, and so on. Combining the average range size and any recent technical levels can be a great way to find a really solid stop loss level. So now you're in the trade and you've placed your stop, the next question is how do you manage the position as the market moves? Well, there are three outcomes to a trade. The price won't move very much, you make a profit, or your stop loss gets hit. So let's look at the first one with the price going nowhere. How long should you leave it? The principle we use to answer this question is to remember the reasons why you entered the trade in the first place. Do those reasons exist? Is the market still thinking about them, or has something new happened and removed it from everyone's mind? If the reason seems like it's still in play and your fundamental analysis for the trade still looks good, then you should hold it. If you start to doubt it or realise that something else has occurred over the news feeds and it could take over the sentiment, then it's best to cut it early and save yourself further losses into your stop loss. This, of course, is a general principle and each trade will merit different actions, but it does serve as a solid guide. So if you're unsure, check your fundamental analysis and see if you would still enter the trade now. If you would, it's good, and if not, then simply exit and note the results for reference later on. Now let's imagine if the price immediately starts moving towards your stop. In this scenario, you should never move your stop to increase its size. However, you may decide that you place your stop loss too close and your fundamental analysis for this trade is still good. In this scenario, it's much better to let your first stop get hit, take the loss, and then think clearly about whether or not you want to re-enter the trade based on your analysis. If you do this while still in the position, it could cloud your judgment and lead to mistakes being made. So while it may seem counterintuitive to allow a stop to be hit when you're still confident in the trade, you will lose less money in the long run. Finally, the trade goes into profit. The general principle that junior traders are taught here is to adjust the stop when the price is halfway to their target, but not to move it to break even, just simply halve the stop loss. So let's visualize this. We're in a trade, we have a stop loss of 100 pips and a target of 100 pips. As the trade reaches 50 pips of open profit, we then simply adjust the stop loss so it's now only 50 pips. So we still have a 100 pip stop loss, but our actual risk is only half of what it was. This is a very simple technique that includes prudent trade management with the ability to take advantage of market volatility without being stopped out early and becoming a victim to it. Again, do not become a robotic follower of any rules. If your trade is within a few pips of your target, there is nothing wrong with taking it off early to bank your money. The principles that junior traders learn are only a framework that they use to operate freely inside to protect from damaging losses. The biggest principle when managing your stop loss is that you should always have one eye on the news feed to make sure your original analysis and fundamental reasons for the trade are still intact. And that little illustration brings us to the next and final piece of our trade management frameworks: how to identify profit targets. When looking for a target, the idea that professionals use is that of finding a price at which the market might lose enthusiasm for that move. This can include previous price levels that the market recently traded from. The market doesn't want to risk the same buyers or sellers coming back into the market at those levels to force the price back towards their entries. So sometimes it's better to take profits around those levels rather than be involved in the battle. Identifying targets is something that can heavily involve technical analysis. Support and resistance is just a different way of describing these levels that the market has recently traded from. So if you're in a trade and notice the price heading towards a strong level of recent or support or resistance, it can definitely be worth taking profits, especially if it will yield the same amount of pips as your initial stop loss. For longer term traders, they're very often analyst prices that are given by top economists and market watchers. These prices are generally solid and they are given by those analysts as levels to look out for where they expect the price to get to. They're pretty good and they can give you a very good guide of what prices you should be aiming for with your long-term positions. You could find these prices on newswires and polls and even ask your coach who has access to more detailed news feeds inside the membership. To make an income from home will require that you apply all the principles we have covered in this course so far, and most of all, practice, practice, practice over the next few weeks. We've structured this program to give you everything you need to reach that goal in just a few months, and in the next video we'll look at the #1 reason most retail traders fail and how professional firms focus their training heavily to make sure that their graduates don't suffer the same fate.